Look, Jim, as well, one thing that we were just talking about a moment ago, in the market trend that we've been watching, especially as we have seen this rapid decline, one of the quickest downturns that we've watched in the history of the markets here. Ultimately, if we are to see, as Hope was bringing up a moment ago, and a very good point, I think, this consolidation of the lows and kind of seeing that drop off de-intensify at this point in time, how do you start to play and put some money back to work, or are you still not touching this with a 10-foot pole?
Yeah, I'm the bear here. I'm not touching this. I think that there's big problems with this market. I am disappointed in what happened today. What the Fed announced today is the biggest move in their 107-year history, times something. They announced more today than they did all of 2008, and it produced a 3% loss in the marketplace right now. I think what Sam said is right. We have the wrong prices in these markets. They have to go lower to find the right price. And the fear is that that right price, look, we're transitioning from a pre-virus era to a post-virus era. Whatever you thought was the way the market used to work in January is not the way it's going to work moving forward. We're not going to have a Great Depression. We're going to have a bad recession in Q2. But beyond that, I don't think it's going to be long lasting. But we're in a period of lower valuations, higher interest rates, less risk, deglobalization, and these markets are quickly repricing. And the Fed pulled the trigger on unlimited, and they produced a 3% loss. In other words, we still have the wrong price. And the fear that I have is that wherever that right price is, I don't know how much more the financial system could take of this kind of a drop this fast. We are hanging together, but barely so. I mean, I'm not going to sugarcoat it here for you. There are some real problems out there. So hopefully you're right that we are starting to slow down. We're going to find a low here soon, and we're going to then stop this bleeding, because I don't know how much more of it we can take.
Is there a gauze pad right now for the bleeding that we're seeing? The early forecasts showing at the worst case scenario, seeming that we could see 30% unemployment. That is a massive number for Americans to wrap their heads around. And for many of us, we haven't necessarily lived through an era of 30% unemployment. And so with that in mind, is there a gauze pad, especially if the Fed or the government as a whole starts to look at industries not only bailing out, but taking stakes, equity stakes in some of these companies, as has been talked about last week? Is there a gauze pad that could stop that bleeding and at least keep some people able to go back to work after this crisis starts to wane? Sam, I'll toss that to you first, and then Jim, since we brought it up, I'll go back to you there.
Well, I think that's what the Fed is trying to do. I believe that's what Congress, their ultimate goal is to do, is to provide some sort of a fiscal package of $2 trillion plus, should they come to some sort of a compromise, so that there can be the financial resources there with which to propel the economy and the market higher once we do get through this 1 or 2 quarter recession. But as Jim mentioned, the concern is, even if you do look to history says that we end up seeing a 10% decline in earnings from the beginning to the end of the recession, and that the PE on the market, the multiple, goes down to around 12. If that were to be repeated, we could be seeing the S&P around 1770, which would be a decline equivalent to what we saw during the tech bubble bursting in 2000 through 02.
Jim, the same question to you, and I'll add on this factor. Bailouts to big businesses, one thing that's being discussed, but what about bailouts to individual citizens? Do you see that being a reality, and what would need to happen for the markets to latch on to something like that?
Well, I think, to answer your question, the gauze pad at this point, it'd probably have to be, getting a handle on the extent of the virus problem in the U.S. We need more testing. We need vastly more testing. So we could say where it is, where it isn't, who has it, who doesn't have it. Excuse me. Once we do that, then we could maybe start to define this problem, because right now it looks open-ended and it's getting worse all of the time. 30% unemployment, by the way, I've looked back at some of the academic studies all the way back to the Civil War. We've never had anything close to that, at least in the last 160 years in the country. So this is going to be something so unprecedented, it's even going to be harder to measure. As far as the stimulus package goes, We need that yesterday. That's not really about trying to put a bottom in the stock market. That's really about helping people that are going to be unemployed, helping people that have lost their jobs, maybe keeping small businesses afloat so they can continue to employ people. That is absolutely going to be needed, because without that, this post-virus world that I'm referring to, if we have that kind of damage to the psyche, that so many people lose their jobs and get angry and upset because of what happened, it's that much longer for us to get past this. If we can cushion that blow, it's that much less time that it will take to get past this. So that stimulus bill, it's not really about bottoming the S&P, but it's about determining how much of a long-term damage that this incident is going to cause for the American public.